Here's the breaking news. Bank of America predicts silver could hit $309 in the near future. Now, pause for a second. Not $30, not $50, $309 per ounce. If that number sounds unbelievable, good, because that reaction is exactly why this story matters. Silver hasn't moved the way people expected, and that's exactly why some institutions believe the real move hasn't started yet. Is this just another exaggerated headline meant to grab attention, or is something quietly shifting underneath the global financial system? Because if this prediction is even partially correct, it doesn't just change silver. It changes inflation expectations, currency confidence, and the way everyday people protect their savings. And here's the part most people miss. This isn't about silver going up. It's about why institutions are suddenly talking about price levels that sound impossible. So today, we're breaking this down calmly, logically, and step by step. No hype, no promises, just the real forces behind this prediction and what it could mean if they collide. But to understand where $309 comes from, we need to rewind. Why this prediction exists. Let's start with the obvious question. Why would a major institution like Bank of America even mention a number like $309? Banks don't do this casually. They don't throw out extreme price targets, unless 1. A structural imbalance exists, 2. Or a historical pattern is being revisited, 3. Or a systemic risk is building beneath the surface, and in silver's case, it's all 3. Here's what most people don't realize. Silver isn't just a precious metal, it's a monetary metal, an industrial metal, a strategic metal. Gold mostly sits in vaults. Silver gets used. Phones, solar panels, medical equipment, electric vehicles, military tech, and unlike gold, silver gets consumed. Once it's used industrially, much of it is gone forever. Now here's where the imbalance begins. For decades, silver prices were suppressed, not by conspiracy, but by structure. Large paper markets, derivatives, futures contracts. More silver was traded on paper than physically existed. That works until it doesn't. And institutions like Bank of America don't look at headlines, they look at stress points. And right now, silver has several. But before we talk price, we need to talk about supply. The supply problem. Silver production is not responding to demand, and this is critical. Most silver is not mined on its own. It's mined as a byproduct of copper, zinc, and lead. That means silver supply doesn't increase just because silver prices rise. It depends on other metals. Now layer this with reality. Mining costs are rising, energy costs are volatile, new mining projects take years, sometimes decades. So when demand spikes, supply can't catch up, and demand is spiking. Clean energy mandates, solar panel expansion, electric vehicles, grid infrastructure upgrades. Silver demand isn't cyclical anymore, it's structural. Now add one more variable. Governments around the world are printing money aggressively, and when confidence in currency weakens, people don't rush to stocks first. They rush to hard assets. That's when silver stops acting like an industrial metal and starts acting like money again. This is the context behind that $309 number. But now comes the uncomfortable question. Has silver ever done anything like this before? Yes, and that's where the story gets interesting. The historical parallel. Let's go back to 1980. Silver didn't rise gradually. It exploded. In just a few years, silver went from under $5 to nearly $50. Adjusted for inflation, that's well over $100 today, and that move happened with lower industrial demand than today, less global monetary stress, smaller financial markets. Now fast forward to today. We have massive sovereign debt, persistent inflation, currency weaponization, geopolitical fragmentation, supply chain fragility. And here's the key difference. Back then, silver demand was partially speculative. Today, it's essential. Solar panels can't function without it. EVs need it. Defense systems rely on it. So when institutions model extreme scenarios, they ask a dangerous question. What happens if silver demand collides with a loss of confidence in fiat currency? That's where numbers like $309 come from. Not predictions, stress tests, worst case scenarios. And if you think that sounds dramatic, ask yourself this. What did $100 oil sound like in 1999? What did $1 trillion deficit sound like in 2000? What did 30 trillion US dollar debt sound like in 2008? Impossible, until it wasn't. Now here's the part that should grab your attention. Silver doesn't need to reach $309 for this story to matter. Even a fraction of that move would be financially disruptive, which brings us to the real risk. The paper versus physical divide. Most people think silver pricing reflects physical reality. It doesn't. It reflects paper contracts. For every ounce of physical silver, there may be hundreds of paper claims. That system works as long as most investors don't demand delivery, confidence stays intact. But confidence is fragile. When institutions start talking about extreme price targets, it signals concern. concern that physical silver availability could tighten, paper markets could disconnect from reality, price discovery could break. If that happens, prices don't rise smoothly. They gap, they spike, they overshoot, and then volatility explodes. Now let me ask you a simple question. If silver shortages emerge, if inflation stays sticky, if currencies keep weakening, where does capital run? It doesn't ask for permission. It moves fast. And silver is one of the smallest major markets on Earth. That's why price moves are violent. That's also why institutions model extreme outcomes. Now we reach the most misunderstood part of this entire story. The real message behind $309 Bank of America isn't telling you to buy silver tomorrow. They're warning about system stress. That number isn't a promise. It's a signal that monetary systems are stretched, hard assets are being reevaluated, traditional assumptions are breaking down. Silver becomes relevant when trust erodes, and trust erodes quietly until it doesn't. This isn't about timing the top, it's about understanding the direction of risk, because when narratives change, prices follow, and usually faster than people expect. Now here's the cliffhanger. If silver really is entering a new regime, then the biggest mistake won't be buying too early. It will be ignoring the signal entirely. So what this means for you. So let's bring this home. Is $309 guaranteed? No. Is it possible under extreme conditions? Yes. But that's not the takeaway. The takeaway is this. When major institutions start modeling outcomes this extreme, they're not predicting the future. They're revealing where the system is weakest. Silver sits at the intersection of inflation, energy transition, currency confidence, industrial necessity. That makes it uniquely sensitive. And sensitivity creates opportunity and risk. So the real question isn't, will silver hit $309? It's, what breaks if it even starts moving aggressively? Because history shows by the time headlines confirm the move, the preparation window is already closing. And that's the part most people regret. In the next phase of this story, we'll look at what happens if silver shortages become visible, how governments respond when metals signal currency stress, and why most people only react after prices explode. So if you want more research-backed breakdowns on money, markets, and global shifts, make sure you're subscribed. Because this silver story, it's not ending here.